Hey, Claire here from Pitt News Magazine. And I have a confession to make. Last June, I tried to scalp a breakout in a tech stock during a week when half of Wall Street was probably on a yacht. Spoiler alert, it didn't break out, it broke down. I didn't know it at the time, but I had walked straight into the summer doldrums. That sneaky stretch where stocks lose momentum, volume dries up, and traders like me learn patience the hard way. Luckily, Jake and Lena are ready to jump in and help us learn all about how to avoid making that mistake. We're diving into seasonal patterns for June, from sleepy equities to sizzling commodities, and how you can use those rhythms to sharpen your trades instead of chasing ghosts. Are you ready? Let's get into it.
Markets, they aren't just random noise, are they? It seems like, much like the weather, they tend to move in rhythms.
Yeah, and they often follow these somewhat predictable seasonal patterns.
Now, obviously, these aren't perfect crystal balls, nothing is. But they do give you a pretty good framework, I think, for understanding, market tendencies.
Helps you spot potential opportunities, or maybe where you need to be a bit more cautious.
It's all about spotting those recurring cycles, right? The things traders have noticed and, leaned on for a long time.
Decades, really.
And June is a really interesting month for this. It often gets overlooked, maybe. But our sources today highlight that it marks this subtle, yet pretty significant shift in market character.
That's a great way to put it. It's often the, let's say, quiet start of the summer doldrums, as they call it, in stocks.
Right.
But, and this is key, it's frequently where the real action hits a peak or at least a major turning point, especially when you look at commodities.
Okay, so that's our mission for this deep dive. We're digging into the sources. You brought these really interesting excerpts from Pitt News Magazine, found via the TradeMiner team.
That's the one.
And we're going to pull out the most important bits, the core insights, to really understand the most consistent seasonal tendencies across different markets, specifically during June. Think of it as your custom analysis to get those key takeaways fast.
Sounds good. We'll break down the patterns, probably start with the stock market view.
Makes sense.
And then we'll shift over to where the source says the real action tends to heat up. That means commodities and futures.
Okay, let's unpack it. Starting with stocks. The main idea from the source seems pretty clear right off the bat. June, historically, that's where momentum often slows down.
Yeah, and uncertainty starts creeping in for equities.
So it sort of kicks off that lower volume, lower volatility drift we often see mid-year.
That's the main takeaway up front, yeah. The market can feel a bit indecisive, choppy, and if you look at the numbers, shows June ranking among the weaker months historically.
For the big indices like the Dow and the S&P 500.
Exactly, especially when you compare it to that typically stronger period, from around November through April. June often underperforms that stretch.
But it's not quite the same story for all stocks, is it? The source did point out a countertrend.
That's true. Small cap stocks, like the Russell 2000 index, they sometimes show a bit of relative strength, particularly early in June.
Why is that?
Well, the article suggests it could be due to some investor rotation, maybe some speculation looking for opportunities.
Before maybe they too get caught in the broader summer slowdown.
Potentially, yes. That seems to be the idea.
What I find really fascinating is how this pattern isn't just about the calendar date. It's this mix of the calendar and, human behavior, right? Psychology.
Definitely. The source digs into those behavioral reasons. Think about institutional investors. They're often waiting for the Q2 earnings reports, which come out later. So June isn't necessarily the time for big, bold, new bets.
So what are they doing?
It's more about rebalancing portfolios, maybe hedging some existing positions or rotating between sectors rather than deploying lots of new risk capital with strong conviction.
And it's not just the institutions, right? Retail investors too.
Yeah, participation tends to thin out. People go on vacation, school's out. Life just pulls attention away from the markets for a lot of folks.
And that drop in participation, fewer buyers and sellers, that leads to lower liquidity.
Precisely. And lower liquidity contributes directly to that choppy price action we talked about. Meaning you see technical patterns like breakouts fail more often. There just isn't enough volume, enough underlying support or pressure to make the moves stick.
So the result is, and I love how the article phrased this, a market that's lazy on the surface, but is quietly repositioning beneath it.
It's a perfect description. Looks calm, but things are shifting underneath.
Which means, if you're watching the markets in June, The source says you need to look out for specific technical clues.
Right, like those false breakouts happening on low volume. That's a classic sign of a choppy June market.
Okay.
Also, keep an eye out for subtle sector rotation. Maybe defensive sectors start getting a bit more attention while the high-flying growth names cool off.
And you mentioned low volatility earlier.
Yeah, that low realized volatility is characteristic. It often squeezes the price of options.
Compresses the premium.
Exactly. Which the article notes can make certain option strategies, the kind that benefit from quiet markets, look more attractive. Things like iron condors or calendar spreads.
Gotcha. There was also that great quote from a floor trader in the source. Something like, June is rarely the start of something big in stocks.
But it's often where the smart money starts laying quiet bets on what's coming next.
That's it, which really begs the question, if the smart money is placing quiet bets while stocks are jonesing, what are they betting on and where?
Well, according to the source, the clues aren't really in the stock market itself during June. You need to shift your focus pretty dramatically.
Over to commodities.
Over to commodities. That's where the source says June really tends to heat up.
Right, it's a major pivot point, and the dynamic is different there.
Totally different. Unlike stocks, which react a lot to sentiment and broad economic news, commodities are often driven by really fundamental, tangible, seasonal forces.
Like what?
Think about weather patterns, consumer demand cycles, like for driving or grilling, agricultural planting, harvesting schedules.
Real world stuff.
Exactly. Real-world cycles making June a particularly dynamic, sometimes high-stakes month for things like grains, livestock, and energy.
Okay, let's break this down. Grains first. Corn and soybeans seem key here.
Yeah. By early June, in the U.S. at least, most of the corn and soybean crops are in the ground. And that's when the weather just becomes the absolute dominant factor. The source talks about this concept it calls peak weather premiums. Basically, traders are obsessing over weather forecasts. Is it going to be too hot, too dry, too wet?
The uncertainty factor.
Huge uncertainty. And that anxiety about potential yield loss gets baked into the price. It builds this weather premium based purely on the possibility of problems down the road.
And the article suggests this premium, this anxiety price, often peaks right around June or maybe early July.
That's the historical tendency, yes. When the uncertainty is highest, before we get more concrete data from the fields later in the summer about how the crops are actually doing.
So seasonally, this is often when corn and soybean futures prices have historically topped out.
Correct. And if that weather premium was high and then the weather turns out okay, or even just not disastrous.
Prices can fall sharply.
They can. The premium comes out fast. The source gives examples like the big drought in 2012 that sent corn prices absolutely soaring through June and July.
I remember that.
Versus, say, a milder scare in 2020 where the fears faded pretty quickly and corn gave back a lot of that premium by late July as the weather improved.
So connecting this, it's not that the market knows there will be a disaster.
No, not at all. It's pricing the possibility of one during that really critical growth stage for the crops.
And that possibility pricing creates the potential for a sharp reversal if things look better. There was that quote.
Yeah. By late June, the corn market is often priced for disaster. If the sky's clear, prices fall fast. Really sums it up.
Okay, moving beyond grains. Livestock. The source mentioned the meat markets and the grilling trade.
Right. Lean hogs, for example, June is typically still a strong period for them.
Because it's peak grilling season.
Exactly. Demand for pork is high. Retailers are stocking up for Father's Day, July 4th, those big summer barbecue holidays.
Okay.
And the seasonal note from the source is that hog futures generally perform well from spring, say April, right through late June or maybe early July. Plus, there's a production lag, right?
Meaning you can't just instantly create more hogs when demand spikes.
Pretty much. Supply takes time to adjust, which can support prices during that peak demand window.
But live cattle is different, the source suggests.
Yeah, it often presents a contrast in June. Cattle prices tend to soften after the big Memorial Day buying push is done.
Why soften?
Well, factors like maybe heavy weights of cattle in feedlots or perhaps weaker export demand can weigh on prices. June often marks that transition from the really strong spring demand for beef to maybe more stable, perhaps slightly lower summer consumption patterns.
Got it. Okay, last big category, energy, gasoline, and crude oil.
June here is right smack in the middle of the summer driving season.
Peak gasoline demand.
Peak gasoline demand. Refineries are churning out the required summer blends, and gasoline prices, they typically hold firm through June and into early July.
before maybe easing off later in the summer.
Often, yeah, once that absolute peak demand starts to tail off a little, it's very sensitive to the weekly inventory reports from the Department of Energy and, of course, travel forecasts.
But crude oil itself, the source said it's more mixed in June, less clear-cut than gasoline.
That's right. It's more variable. Sure, strong demand from refineries needing crude to make all that gasoline can be supportive.
Or tight crude oil inventories.
Right, those can create a bullish bias. But crude prices in June are often just as influenced, sometimes more influenced, by geopolitics, OPEC decisions, things like that, as they are by purely seasonal demand shifts.
So less reliably seasonal on its own compared to gasoline.
Generally, yes. More factors at play.
Okay. And the source also threw in a couple of bonus markets with June tendencies, gold and the U.S. dollar.
Just briefly, yeah. Gold often shows a typical seasonal pause or even some softness in June.
Quiet month for gold, usually.
Tends to be, unless you get a big macro scare or some geopolitical event that drives sudden safe haven buying.
But interestingly, that June weakness,
yeah,
the source mentioned it could potentially set up buying opportunities.
For the seasonally stronger period that often follows for gold, usually around August, September. So a June dip might be watched by longer-term bulls.
And the U.S. dollar.
The article noted a tendency for the dollar to strengthen, specifically in late June.
Any reason why?
Often attributed to things like corporate repatriation flows, companies bringing money back home, and also quarter-end rebalancing by big institutional players adjusting their currency exposures.
So it might drift early in the month and then tighten up later.
That's the potential pattern, yeah.
Okay, let's try and wrap this up then. Pulling together the main threads from the source material. The big takeaway seems to be, while June might look quiet, maybe even a bit boring for the stock market overall, it's anything but quiet in many key commodity and futures markets. It acts as this critical pivot point.
And it really shows how those real-world cycles, planting, weather, driving, grilling, directly feed into potential price patterns in the financial world.
Yeah, that connection is clear. But the article was careful to add a caveat, right, about seasonality.
Absolutely. It stressed that these seasonal tendencies, even though they can be pretty powerful indicators, they aren't rigid laws.
They're signals, not guarantees.
Exactly. You can't just trade only based on the calendar. But they're consistent enough that smart traders often lean on them, incorporate them into their overall market view.
That quote summed it up nicely. Seasonal trades don't promise, they suggest. And June has plenty to say.
Perfect summary.
So, what does this all mean for you listening in? I guess understanding these different vibes for June quiet stocks, active commodities, helps you adjust your expectations, right?
Yeah, expectations for how different markets are likely to behave. And it might help you spot periods where the odds seasonally lean one way or another.
Or where, like the article hinted, the real moves aren't always where the crowd is looking. Maybe the action isn't in the S&P 500 in June, but it's definitely happening in corn or gasoline.
Could be. It widens your perspective.
And maybe here's a final thought, something to chew on. Just think about how deeply connected these complex financial markets still are to the basic rhythms of the physical world. Planting cycles determining grain prices, summer heat influencing energy, vacation driving, even backyard barbecues.
All leaving their mark on the charts.
Exactly. Just highlights that really powerful, tangible link between the physical world we live in and the financial one, even in a month that people often just write off as dull.
After reading this article and recording this episode, I looked back at my trading journal charts from last June, and yep, there it was. Tight ranges, weak breakouts, all the signs were there, blinking like neon. Claire, this is not the time to be aggressive. If I'd known then what I know now about seasonals, and especially what June tends to not deliver, I would have traded it totally differently. Maybe taken a break. Maybe rotated into commodities. Maybe just gone outside. That's why I picked this article for today. Because sometimes the best trade you can make is knowing when not to trade. Big thanks to the Trade Miner team over at Gecko Software for putting together such a smart, seasonal breakdown. And if you haven't picked up your copy of Trade Miner yet, the software we use at Pitt News Magazine to find these seasonal trends, you can grab your copy at trademinerpro.com. That's TRADE, Miner, MINER, pro.com. Seriously, it's one of the best tools in my trading toolbox. And of course, head over to pittnews.com and subscribe to Pitt News Magazine. It's where all the good stuff starts, including the wisdom that might save you from a summer slump like mine. See you next week.